It's a pleasure to be here with all of you. I know when you hear tax attorney, I know I have some fellow attorneys in the crowd. Your excitement level goes through the roof. But David just did an amazing job on the deep end of the pool with a very important tool, the Internal Revenue Code. We're going to go over to the shallow end of the pool. So I want to invite y'all all over to the shallow end of the pool. And this tool is very applicable to many of your clients. But all of you accountants work with estate planning lawyers. And they're programmed from birth to care about a certain tax more than another type of tax. That estate tax that no one has to pay. So I learned early on in my career that clients care infinitely more about income taxes than estate taxes. So the tool we're about to start with now, our industry has, to its own fault, positioned it in the estate planning realm way too much. We're going to talk about it in the income tax planning realm because that's what clients care about, right? Who cares about estate taxes? Who pays estate taxes? No one. No one does. And even the ones that have to pay it don't care about it nearly as much as income taxes. So what a wonderful idea to come up and focus on the version of the Charitable Lead Annuity Trust, which this is, which is just designed for income tax planning. So that's what this is. Many of you have probably done charitable lead trusts and probably have nightmares from it because that's a very complicated transaction and it's applicable for just a few people. This is a dumbed down, stripped down, simplified charitable lead annuity trust that's just designed for income tax mitigation, which is why we're here. Income tax savings now from future annual gifts to charity. That's it, okay? Leveraging income tax savings now when your clients need it for future annual gifts to charity. So I want to talk about just the facts. I want you to leave here with another arrow in your quiver so you know when to bring this out of your quiver and when not to. Because everything we've been talking about today applies to certain types of clients. So when you leave here, y'all are going to be experts compared to your colleagues that aren't familiar with this less familiar type of charitable lead trust. So we're talking about what it is, how it saves taxes, who's the ideal client, and why now is the right time for it. So what is it? All a charitable lead annuity trust is a trust that's set up, has some assets in it, and for a period of time, it can be 2 years, it can be 100 years, annual payments go to charity for a period of time. And then at the end of the term, one of two things happen. It either goes to family and complicated trust, spouse, you're dealing with complicated issues for death, or it comes back to your client. It's a reversionary charitable lead trust. It's been around for 40 plus years. No one talks about it. The whole thing was birthed out of the estate planning industry in the 90s when the exemptions were $625,000 per spouse and everyone had an estate tax problem. The industry has forgotten about this simpler version where it's just reversionary. The Ferrari is the traditional lead trust. It's perfectly legal to drive a Ferrari and to have it, it's a smaller market. I tried to get a Lexus. That kind of looks like a souped up Lexus, but it's just a Lexus. What we're talking about today is much simpler and more applicable because even the people that drive Ferraris or want these complicated vehicles, the IRS notices you when you're driving one of those, and if it breaks down, it's very expensive. And it's just a smaller market. So this is my undergraduate marketing degree to try to tell you the type of client that we're talking about. Some people, if you remember the cars, this is the Lexus of charitable lead trusts, or Corolla, or Honda Accord. So what does it look like? There's 3 stages, okay? You got a client. Stage 2, they go set up an iCLAT. Guess who the trustee is all the time? Your client. Which is nice because clients like control, right? They don't want to name their brother or a trust company or they want control. Unlike the Ferrari, the level of control with this tool is exponentially higher because we're not doing estate planning. If they die, it's in the gross estate. We don't care about estate planning. That's a different tool in the toolbox. So all this is going down. There's a Chase Bank right here. So you're walking into your new bank account. Your bank, and you set up a new bank account that you're the trustee of. It's called the Brad Gornto Charitable Lead Trust. I'm the trustee of it. And you move some money into it. And then for a period of time, I'm going to make my normal annual payments to the charities that I love, including my place of worship, the alma mater, just a donor advised fund, a private foundation, yes, a private foundation, impact funds. It's an annual giving tool. And then this is the unique thing about the iCLAT, and the reason you see the logo, is at the end of the term, whatever's left in that account that I went over here to Chase Bank and I invested is going to come back to me in a non-taxable transaction. This is a grantor trust for income tax purposes. It's a tax nothing. No tax recognition on the way in and no tax recognition on the way out. So that's the structure. That's the what. Next is how. How does it save estate taxes? 2 words, present value. I don't have to tell you guys what present value is. The deduction, unlike any other charitable tool in the toolbox, the deduction that comes off of this has absolutely nothing to do with what you put into it, which is very unique in this industry. It's usually like what you put in the DAF, what do you put in the CRT? I got to go pay 10 appraisers to appraise this. No, the deduction is based on the present value of the annual payments you're making to charity. And we've had over a decade of ridiculously low interest rates, and that when you have a low interest rate, it generates a very large year 1 charitable deduction, okay? Interest rates are going up a little higher, as maybe y'all heard. In 2008, 2009, people were giddy as all get out with this tool, particularly in the wealth transfer, life insurance industry, when interest rates got below 4%. So we've had over a decade of ridiculously low interest rates. Now we're getting into the low interest rate environment, and the tool is still very, very powerful. If you don't, it again has nothing to do with what you put into it. It has a little bit to do with it, not much. But it's a present value play, and we're going to go into a case study. The discount rate right now is 3.6. That went up 2 days ago from 3%. Before that, it was at 2% and then 1%. When I was doing these in December of last year, we were at 1%. So if you could turn back time, right? If you don't look at anything, just look at this. This is how many clients of yours give at least $2,000 to charity a month, maybe 25 grand a year, probably a lot. This is not Rockefeller or T. Boone Pickens or Buffett type annual givers or Bill Gates. These are people that give around 25 grand a year. So let's take someone who gives they're going to do it for 10 years. It's part of their financial plan. It's part of what they do. Well, the deduction they get in year 1 is simply the present value of that payment stream for 10 years. It's $206,000 today. That's 82% of the promise they're going to give over the period, over that period of time. So this is a very attractive tool. Talk about the 20% ideal clients that Jeff talked about at the beginning. Helping you focus on the ideal clients that you want. I think a lot of people who give between $100 grand and $10,000 a year to charity represent a lot of your ideal clients. This is a tool that brings tremendous value. Look at the 20-year. I'm sorry, this is 25-year, isn't it? I should look down here. That's $625,000 over 25 years. That generates a $400,000 deduction this year, okay? This is a helpful slide. Again, it's just present value calculations. Yes, there's some moving parts, but I meant it when we said we're on the shallow end of the pool, particularly compared to traditional lead trusts. Hopefully that's resonated. Who are your ideal clients, okay? There's ideal clients, and then there's ideal clients, right? For all of the tools that we use. These are the ideal clients, okay? You want to bring this up to someone who's already a charitable giver. I forget who I was talking to in the hall. I have a booth over there. You've got to be charitably inclined, okay? Because they're still outlaying money to charity. If a person has not a philanthropic bone in their body, which is pretty low threshold, the definition of charity is very wide open, they got to be giving at least this. So you want to start with your annual giver clients. Start with $10,000 a year or more to charity, okay? And this includes tithing and your offering and less than $1,000 a month. And then there's 2 fact patterns, okay? And this is where my slides got condensed down. Come see me if you want the detail. Ideal scenario number 1 is the annual giver with a spike income tax event, okay? Roth conversion, spike income tax event. Bonuses, contingency fees. Lawyers get paid nothing and then they get a big fee, contingency fee income. Business sales, stock options, deferred comp. We did one yesterday for the guy who got his final payment on a business sale. It was the earn-out payment. He got $3 million. Well, That was a huge spike, so we captured a massive deduction to mitigate that tax. So think of the ideal scenario. This is really complicated stuff, I know. It's annual giving, spike income, or annual giving, and they're making a lot of money now, and they're about to retire. Your physicians, your executives, your athletes who are making beaucoup money now. They don't think twice about their charitable deduction because they have so much income. Next year, they're about to have no income. Wouldn't it be nice to capture the next 20 years of their desired annual giving in the last year? Okay? Those are your two demographics. So any of you have any clients that fit those demographics, your clients are going to be thankful that you bring it up, regardless of whether they do it or not, because you're bringing a tool that's very applicable to them under their scenario. And there's really no more calculus to it. It's that's it. This is the ideal scenarios. There are some others, but these are the two ideal ones. This is ideal scenario number one. So you got a bunch of states up there. Florida and Texas, we're special. We have no income tax. So therefore, we have no charitable deduction at the state level. The far right column are the states that do have an income tax, but no charitable deduction last time I checked. So they're up there. If the check mark represents those people because you're not getting any tax savings at the state level. The bullseye is where you want to be. If you're in California, New York, Oregon, which is where we do most of these, if the state has a state income tax and a charitable deduction, and that's what the ones on the bottom are, then if you practice in those states on the bottom level, then your clients are going to be, whether they do it or not, they are going to appreciate you bring it to their attention. Why now? And I mean right now. Anyone want to take a guess? Interest rates. That's right. So this is a simple example. This is the deduction based on 10 years, $50,000 a year to charity, I believe. But we have the 3.6 rate through the end of September, okay? And then it's going to bump up to 3.8. Here is just hypotheticals to show you the tax savings. I don't think there's a pointer. But the deduction today, if someone was going to do a $50,000 for 10 years, the deduction would be $413,000. If they do the same one at the end of the year, when we might be at 5%, the deduction is going to be $386,000. Not earth-shattering money, but $10,000 decrease in the tax savings. That's real money for just waiting. So once we get north of 8%, then certainly the golden age of lead trust planning is done, but there's still time. So I have a case study. All right, this is a real case study. Peter gives $40,000 a year to his favorite charities, including his church, and he anticipates doing so for the next 12 years. Based on the advice of his financial planner and his CPA, Peter decided to convert his $1 million traditional IRA to a Roth. Peter is a California resident, and he has a donor-advised fund. The vertical column right in the middle, that's the annual payments to charity, $40,000 a year, $400,000, $354,000 deduction for doing nothing other than what they're already doing. They are moving money into a new account, don't get me wrong. They're saving $177,000. They're not writing a check to charity for $354,000. They're opening up a new account that they control, from which is making $40,000 annual payments to charity each year. That's what they're doing. So the $1 million question is, what's that top left number up there? Why is that 500,000? Why is that not $1 million so I can get all of my $1 million back at the end of the term? And you can do it that way. The traditional wealth transfer lead trust is designed to shift millions of dollars of wealth and escape estate taxes. So all the software out there that does this is trying to do this so you get the whole tree back at the end of the term. But clients are smart, and they ask questions like, can I live out of this? And I say, no. So it's tied up for the 10-year period. I say, yes. But you can buy and sell stocks, put it in oil and gas, do a 1031 exchange with the real estate that's in it. You just can't live out of it, and you can't use it to guarantee indebtedness. There's private foundation rules applied to it. So I said, well, that doesn't sound too good. I like controlling my money. So what's the minimum amount I need to put in this darn thing to get that deduction? Okay, I'll say that again. If you were doing one of these and you need the deduction, wouldn't you like to have the money in your left pocket where you can do whatever you want with it versus in this right pocket, the iCLAT, where you're kind of limited? So a lot of clients will ask, what's the minimum amount I need to do to put in this thing? Here, the sum of the payments for 12 years is $480,000. We funded it with $500,000. The minimum amount we could have funded this with would have been $354,000. And this is the unique part of this offering, for lack of a better term, in the market. It has nothing to do with estate planning and appreciating assets, and it makes the engagement extremely simple. Because we're not talking about death, we're not worried about the asset. You don't have to get an appraisal. We'll get back to that. I'm sure I got a lot of people's attention there. Because the deduction is based on the present value of the payments to charity, not the value what you're putting into it. It is important. You do have to report it on the 5227. I'm off on a tangent, which I have a tendency to do. But bottom line is if you put $500 in here, and what did I do? 5% annual rate of return, which is, of course, fictitious. If you do all of that, the amount that reverts back to you in a non-taxable transaction would be $261,000. Of course, if you funded it with $1 million, you're going to get all the $1 million back, and more so than that, or if it explodes in value. But for people who are already annual givers, this is coming out of their assets already, okay? So what this is, it's baked into their financial plan. So it's a more tax-efficient way of doing it. On the far right, I know it's hard to see these numbers, but it's showing the tax savings from the deduction. The future value of that $177,000 of tax savings over the 12 years is $303,000. So when you add that, plus what comes back to them from the iCLAT, you're looking at $564,000. So again, the key idea is what? Do you all remember it from the beginning? Income tax savings now from future annual gifts to charity. Thank you, everyone, and enjoy the rest of your conference.